Stock market 2023. What's going to happen this year? Happy New Year. And let's dig right into it. So the one thing we cannot control is what the market does. It's going to do whatever it's going to do. What we can control is what we do, our behavioral finance, as they call it. And that's one of the things I want to show you today. So the market, when I say the market, I'm talking about the S&P 500 over the last 100 years has returned about 8 to 10% on average. And yet, what's interesting is the average person has not made 8 to 10% in the stock market holding over a long period of time. So why is that? In fact, the average person's only made 2.1% holding in the S&P over the long period of time. So wait a minute, how can that be? How can the stock market go up an average of 10% annualized and the average person only makes 2.1%? Where's the disconnect? Well, that's where this article comes in. So give credit where credit is due. You can see, by the way, I'll put these links down in the description as well. This comes from Business Insider, as you can see. And let's see where we go here. So this is from BlackRock, BlackRock's chart of the week. Very telling, very telling. So as you can see here, I can't highlight that because it's an image. The average investor underperforms the 20-year analyzed returns by asset class, 1992 to 2011. Okay, again, source BlackRock, Bloomberg, Informa Investment Solutions, Dalbar. So as you see here, the average investor has only returned an annualized return of 2.1%. per year over the last 20 years. The S&P, there you go, 7.8, almost 8%. Okay, that's just 20 years. So what the heck? What's going on? Okay, I'll tell you what's going on. What's going on is behavioral finance. People, how they behave with the markets. So unfortunately, most people do not just put their money in and leave it in. They try to time the tops, they try to time the bottoms, and that's where they're losing out. In fact, let me share another point with you. So why does that happen? And it's all because of what we call behavioral finance, which you might know is just, in layman's terms, fear and greed, FOMO and FUD, hesitation and exuberance. So what typically happens is that we go through market cycles. Okay, market goes up and it comes down. Market goes up and it comes down. Market comes up. Okay, we'll just finish there. Again, we're just going to show you the general paradigm, the meta pattern, so to say. So let's say that people got in somewhere around here and then they're excited. Oh, my P&L is going up. Well, my P is going up. My profit's going up. And yay, everything is exciting. My money manager is a genius. I love my financial planner. Or I'm a genius, you know, if they made the decisions, whatever. And then the markets come down, down, down. But they don't know if this is, first they'll think, okay, well, it's a normal correction. Of course, they're listening to all the spokespeople and they're like, everyone's got a different opinion. But they're like, okay, well, a little correction here. Corrections are normal. And that's what they're thinking here. But then the market comes down further and they're like, oh no, lost half my money. From there to there, gave back half my money. This is getting serious. But people, they told me just stay into the market, hold, you know, just buy and hold, just buy and hold. Okay, I'll buy and hold. And then the market goes all the way down to here. And now they're like, oh, you know what? No way. I can't do this anymore. Now I'm in the red. And this is no bueno. I can't tolerate this. I'm freaking out. I'm losing my money. They're thinking about their retirement. They're getting scared. And so then they get out. And that's right about the time, usually, you know, like they say, when blood's running in the streets, that's the best time to get into the market. Well, the blood's running in the streets, the red of the P&L, it's no longer green, now it's red, and people are emotional and they're freaking out, so they get out. And then, of course, the market turns around, goes back in the original direction of their trade, and then, like, oh man, I should have just stayed in. I can't believe it, but when it goes back up, they don't get in right away because they're still dealing with the emotion, the emotional damage, the emotional trauma. Like, I'm out of the market. And usually they'll go to something else, whatever is popular. So that it's interesting how people's attention will go from one thing to another. It might be tax liens or real estate or, whatever. And so then all those kind of seminars pick up and people start going to those until, of course, those will all have the same cycles too. So then people come in and they're like, finally, they say, you know what? I think this market up move is actually sustainable. Oh, you know what? I'm going to try it again. And so then they finally enter when there is an uptrend confirmed. But they wait and they wait and they wait and they wait until everything is confirmed and everybody's like, yeah, this is good. All right, market's moving up again. So now people want to get in and they get in and then the same thing happens again. And they're like, oh no, not this time. Oh, that's okay. Normal retrace. Ooh, really bad. And then they get out here. And then it turns around and goes back up and you see the cycle all playing out again. It's an emotional fear-greed cycle of human financial behavioral finance, as we call it. And so they're always on the wrong side of the market. Now, if they were to buy and hold for the last 10, 20, 30 years, yeah, they would have made those nice 8, 9, 10% gains. But they didn't, because they're always playing the wrong end because of fear and greed and because this is scary. Really, really, really scary. And I get it. Now, let me show you something else. Okay, so now we're going to look at one more website today, and this is from Hartford Funds. You can see it there. Again, I'll put a link to this in the description below. And we're going to go down and look at this chart tab right down here. In fact, I'll include that paragraph. All right, so look at this. It's not just about getting in and out during those cycles. But I'll highlight this here, if you miss the market's 10 best days over the past 30 years, get that, 30 years, and you only missed the market's 10 best days, your returns would have been cut in half. Wow. 10 days out of 30 years? And if you miss the best 30 days in those 30 years, your returns would have been reduced by an astonishing 83%. Oh my gosh, that's crazy. And here you can see they have a nice chart here. So if you miss the best 30 days, again, over 30 years, they give you the dates here, you'd only make $35,785 as opposed to just buy and hold fully invested for the every day for all those 30 years, $208,215. So, wow, right? Incredible. So, investing is very different than trading. Very different than trading. In trading, we're trading short term. So if you're intraday trading, you're day trading. If you're swing trading, you're holding for multiple days, but just for short-term periods. And so then timing is involved, absolutely. And so I rely heavily on timing my entries and exits when I'm day trading and swing trading. And for that, I've got my timing indicator, which if you're interested, I give it to all my viewers for free. Go to indicatorwebinar.com, where I'll give you a full tutorial of what it is. First of all, it's a modified indicator already in your charts. But again, we modify it. I show you how to set it up on your charts, how to trade it. There's certain patterns on the indicator we trade. And I use this to nail cycle lows in nail cycle highs. And you can use it for investing as well. It's just a matter of, again, why miss out on those best, 30 days? And don't treat investing like trading. It's a whole different thing. Now, for day trading, for swing trading, use my cycle indicator for sure. And you can get it there oh, by the way, also, subscribe to the channel. I've been doing a lot of investing videos lately, and I'll put links to some of those in the description below as well. I've been doing a little bit of series on investing as opposed to trading. We'll get back to the trading stuff here real soon. So subscribe, and you get notified when videos come out.